Welcome to everyone on the webinar today. We're going to break our presentation up into three parts. The first part will be market strategy, where we remind you of the four key themes that we're covering throughout 2025. The second part will be the market recap, and the headline there is the world partied, and I'll show you just how great second quarter was for pretty much every investor, no matter where they were. The last part is the market outlook. The headline there is "It's time for a plan." I hope to show you some interesting aspects of financial planning, some of it related to the new tax laws that we're living under. So let's go ahead and jump in with market strategy. And this might be familiar to you. We opened up the year warning people about a possible tech or crypto crash. And we kind of had a mini crash in the first quarter, but tech stocks have come back even beyond the highs they were at. I'm a bit worried about that. But the next headline there is "It's time to diversify," because the public stock market is over-concentrated. If you went out and bought an S&P 500 index, nearly 40% of that is in just 10 stocks. So you're not diversified if you're just investing in the public stock market. The third key theme is the one we're going to explore in depth today. Financial planning is critical. We always talk about looking for hidden and unnecessary risks, but there's actually some real return opportunities out there, especially with some changes in the tax law, and we'll do a deep dive into that, and I'll show you what I'm talking about. The fourth key theme to just mention today is this idea that safer assets continue to be productive. Now, for much of my career and for much of the investing life of folks on the webinar today, you've known that if you had money sitting in cash, you weren't even earning a rate of return that would keep up with inflation. So investing in cash or letting assets sit in cash was really just a prescription for losing your purchasing power. Well, that's not the case right now. And we even offer a treasury strategy that we call short-term tactical that allow you to stash some money that you're planning to spend, or you're planning to use to purchase something, or maybe you got an exit from private equity and you're just not sure what you're going to do with that money from an investing standpoint. There's a strategy for that while you figure out what you're going to do with it, or wait to write that check. And then you're not losing to inflation. So they're actually productive. You're actually growing your real asset base after the corrosive effects of inflation by being perfectly safe. So that is kind of a newish thing. We've been able to do that for a couple of years and should be able to do that for a few years more. So let's jump into the Q2 market recap. And the headline again is "The World Partied." So let's take a look at this chart of country returns. And this is unusual for us. We always see some countries that had a better return and some countries that had a worse return. You'll see the U.S. in there in green, just slightly lagging the global average. But it is rare, even in a really great quarter for the U.S., to see that many countries that were positive. Just a few of these almost 50 top countries were in negative territory. Saudi Arabia was down a little bit, but even countries that have a lot going on, such as Israel and Taiwan, have global threats lurking in the background to their economies, and their societies even had terrific returns for Q2. So these are expressed in dollar-based returns, so you get a little bit of currency translation effect going on with that. But again, it almost didn't matter where you were in the world. The second quarter of 2025 was a terrific year to be in the stock market. Looking through the quarter in terms of the global stock market index, from our perspective, we started with what could have been a bunch of negative news, including some Trump tariffs that got the market panicked. But when some of those got rolled back, the market just rallied and never looked back. We even had the U.S. Treasuries get downgraded by Moody's, and that didn't really seem to have an effect. It was way back in more than a decade ago when Standard & Poor's downgraded treasuries and everybody went out and bought treasuries. And I think Fitch downgraded treasuries in 2023. So this was really just Moody's joining the party pretty late. But our treasuries continue to be well accepted in the market. And, the U.S. government can issue 30-year debt at less than 5%. So the market's really not believing that there's a problem with the full faith and credit of the U.S. government. We did have a couple of headlines in there that I hesitated to put as red or green, meaning bad or good, in the sense that I think the jury is still out, but the attack on Iran by Israel, followed up with an attack by the U.S. on Iran's nuclear sites, may have actually lowered the perception of risk in the Middle East, but the market really didn't seem to care, and we continued to just truck on upwards even after those pretty significant events. This page may look familiar because if you've had a chance to review your own quarterly portfolio report for the second quarter, this page is also in that report. And what you'll see for the 3 months ended June 30th, that the fixed income market did okay, up 1.21%, certainly better than the average that we've seen over the last 5 years, which contains in it 2022, when the fixed income index was down 13%. Our clients, of course, have done way better than that. We dodged almost all of that risk in 2022. But really of note is what happened with the global equity index in the last 3 months, up 11.62%. So it makes for a pretty good 1 year, 3 year, 5 year, and even 10-year returns, maybe even a little bit rosier than we're going to expect in the future. We model that over the next 20 years, the stock market is going to go up between 8 and 9% per year on average. So this last quarter was really a pretty good year. We got all green arrows as we break things down for the quarter into the constituent parts of the market a little bit more. If you're just looking at the numbers there at the top, you'll see that the international markets, again, did a little bit better than the U.S. did. And that had something to do with the fact that the U.S. dollar slipped, meaning those foreign currencies appreciated. And so the currency appreciation magnified the stock market returns. We're nowhere near the best quarter that we've seen since 2001. And of course, those negative quarters are a bit of a distant memory, although for the fixed income market, the most negative quarter we've ever seen was just in 2022, as we talked about. So again, lots of reasons to celebrate. There wasn't one part of the market when you chop it into these 6 parts that was negative. Now we get to something kind of extra interesting for me. If you look at the bar chart in the top right of this slide, you'll see that once again, large cap growth stocks did the best. Now, this is exactly the opposite of what happened in the first quarter. And in fact, if you look at the year-to-date column, you'll see that large cap growth and large cap value are just about tied in terms of their return. So as a reminder, in the first quarter of 2025, tech stocks really took it on the chin. And going into that, I was looking at the price earnings ratios of those biggest stocks, the top 10, and they were pretty scary. Well, they are back up to those levels. In fact, if you went out and bought the S&P 500 index, as I mentioned before, nearly 40% of that index would be in just 10 stocks. If you were to do that today, NVIDIA would be over 8% of that supposedly diversified investment. Microsoft would be over 7%. Apple would be over 6%. Well, the forward-looking price earnings ratio, which again would account for the growth that we're expecting to get next year in those companies, would still put NVIDIA at a PE of over 40, Microsoft well over 30, Apple at about 30, Amazon at about 35. That is very expensive for stocks. And so I don't know if we're getting ourselves set up to see another big pullback in growth stocks in the large part of the market, but it wouldn't be a surprise. So we may get several runs at this idea that we're worried about a crash happening in the large cap growth part of the market. We certainly know that over the long run, value stocks tend to do better, but we've had a bunch of surges in tech stocks over the last decade. And I'll just tell you that when that retreats, when that goes away, it tends to go away very painfully. And so we're on the watch for that as this year progresses. Looking at the international developed markets, what we see is that small cap led the way, a little bit different from what we've seen in the U.S. But in those markets, we've seen value do very well over the long term, something that we've seen over the very long term in the U.S., and we certainly saw in Q1 in the U.S. And so the play into value has been an ever-present theme over the last few years, certainly the last 5 years in the international markets. But again, all good news. And our returns as dollar-based investors are the darker lines there, which reflects the currency translation benefit that we all received. It's always nice when international emerging markets do well because there's been a number of quarters where they have not, but they've been playing a little bit of catch up. And we overweight to small cap. That part of emerging markets was up 17% in Q2. So a nice little relief rally. And again, that small cap overweight has helped us for a number of years. We're happy to have that. So nothing but good news in emerging markets. And now the infamous slide about fixed income. I'm not going to talk about this at great length today. However, I do want to call out just a couple of things. The top middle part of the fixed income slide here shows you what we call the yield curve for U.S. Treasuries. And that depicts the interest rate that the federal government has to offer to borrow money for 1 month, 3 months, all the way out to 30 years. And there's not been a lot of movement for the price of treasuries for 30 years at the moment. It's a little bit less than 5%. And so these three treasury curves depicted here show you the end of June. They show you 3 months before that, and they show you a year before that. And again, a little bit of movement in the middle part of the curve in the longer end, but not much at all. Where you do see a lot of movement is on the short end of the curve. Now, the futures market telling us what will happen when the Federal Reserve next meets has been moving around quite a bit. Every time we thought that the Fed was about to lower interest rates, that's been delayed. Right now, the market has over 90% confidence that at the meeting on, I believe it's September 17th, the Federal Reserve will, in fact, finally go ahead and lower interest rates. And when you see this kind of distortion or this kink in the curve at the lower end of it, what you know for sure is that the Federal Reserve is either too early or too late with its moves. The market has already anticipated what needs to happen. And in this case, the market has been anticipating for some time that the Fed is finally going to have to catch up to things a little bit and lower interest rates. The shape of the curve is supposed to be one where short-term interest rates are lower and long-term interest rates are higher. And so if the Fed lowers interest rates one time, we're almost there. If they lower interest rates 2 times, we're definitely there. We've been waiting for that and predicting that that was imminent for about 6 months now. Certainly folks that listen to these webcasts and attend in person have heard me say for a number of years that the Federal Reserve seems to always be late. And that's because they tend to look at inflation data and employment data through the rearview mirror, I think, instead of what's coming. And so I think that they'll be once again in a game of playing catch up a little bit. So I'm definitely looking to the next meeting about 5 weeks out for the Fed to lower interest rates and then maybe one more time before the year is out. We're going to show a few more slides with some market data here because we want to focus on the idea of inflation. We're focusing on inflation for just a moment because that is the big debate. We had CPI numbers come out at the beginning of the week. We had producer price index numbers come out later in the week. And depending on what headlines you're reading, either they were what was expected or maybe they're running a little bit high. But actually, there's data within those if you were to dissect them in a way that we don't quite have time for today that would suggest that inflation is actually pretty well under control at the moment. Another way to see this happening in real time is what's happening with the price of commodities. And in the second quarter, most commodity prices got cheaper. In fact, if you roll that up into an index, we see the commodity pricing was down over 3% for the quarter. That is an indication of what's yet to come as the price of commodities gets reflected in the cost to producers and eventually the cost to consumers. So that's one bit of data there that suggests that inflation is in fact going to be contained or even fall just a little bit. Another significant thing to look at is the personal consumption expenditure data that the Federal Reserve likes to look at. And there's multiple versions of this, but it's the trimmed mean, meaning they're really getting rid of the most volatile parts of that show that the June release was at an annual inflation rate of 2.7%. But I like to look also at another piece of data that I get out of the Federal Reserve Economic Database, or the FRED database as it's known. And that is a very peculiar inflation measure, and one that I've not found to be covered in any of the popular financial media outlets. And that's what we refer to as sticky inflation. If you go back about a year, I did a quarterly market report where I did a deep dive into all the different types of inflation measures and what they mean and how we get there. But think of sticky inflation as inflation for the parts of the consumer market that tend to move pretty slowly. They moved rapidly around the pandemic. They ran up, again, exacerbated by the Federal Reserve's unwillingness to move off of their zero interest rate policy. But once they finally did, that came down. And we tend to observe a bit more momentum in this measure than we see in some of the more volatile food, energy, and other parts of the inflation basket that the CPI would measure. And so with this sticky price index continuing to come down, I think there probably is some momentum to that, and the more volatile parts of the measure often tend to follow that. So think of houses, think of cars. In fact, real estate prices are falling in 26 states at the moment. So I think we're going to be seeing some easing in parts of this that perhaps the Fed is not looking at as closely as I am. Again, I think it's evidence that inflation may be a little bit more under control, despite the inflationary effects of tariffs, than we would have anticipated. So one last bit about inflation is actually a comment on the job market, because what's happening in the employment market affects the inflation that we see. So I won't go into how all these things are linked together in depth, but there was a news release that came out about Bureau of Labor Statistics data being a bit pessimistic and revising some past data. But that wasn't the one I'm showing you. The one I'm showing you here came out in August of 2024, just 3 months before the presidential election, which was one of the biggest revisions downward that we've ever seen. So I put this up here for a couple of reasons. One is to remind people that regardless of who's in the White House, the Bureau of Labor Statistics may be likely to revise downward prior inflation measures. So again, just 3 months before the last election under Biden's watch, with Kamala Harris running for president, one of the biggest revisions downwards that we've ever seen happened, really only topped by one that occurred during the Great Recession. And so this big loss of employment numbers in the record there certainly had a lot of people concerned. But every month when data comes out, the prior 2 months get an adjustment as more data comes in from surveys and other techniques that are employed every month by the Bureau of Labor Statistics. But the really big revision is the one that happens once the BLS gets a hold of all the tax returns, because there's much more comprehensive data in there. So the plan, as I've heard it announced by the new head of the Bureau of Labor Statistics, would be to shift to quarterly reporting and perhaps away from the volatile monthly reporting that's always getting corrected. But I don't think that's going to give us the accuracy that we hope for. It wouldn't be until we get the annual revision that we really know even what the prior 12 months looked like. And so just keep that in mind, that there's a big revision that occurs in August, and we might be about to get the next one that would look back from April 2024 to March 2025. So fingers crossed that that's not terribly bad. One more point to make about this is that if the argument is that the Fed needs to lower interest rates, then one of the things that would cement that argument the best would be to say the employment market is getting a little bit weaker. So we'll see how the political arguments get made as that next revision comes out. So this is the best employment data that we know to have at the moment, and that includes those last revisions. But I put up this slide not to belabor the employment conversation and what that might mean for inflation, but to actually put forth even a different hypothesis again, one that I haven't heard either of the political parties embracing, and that would be this. We have another survey out there that comes from the Bureau of Labor Statistics. It's called the JOLT survey, and that's the Job Opening and Labor Turnover survey. And right now, the JOLT survey is telling us that the U.S. has about 7.5 million unfilled jobs. 7.5 million. And I still remember the first time we got over 5 million. I just couldn't believe that it was such a great market for somebody looking for a job. Now, there's lots of stories out there where it's hard to find a job. It really depends on the field that you're in, but there's 7.5 million unfilled positions in the US right now. You might also be interested to know that there's well over 400,000 unfilled positions in manufacturing. And so our manufacturing sector can't really grow enough to keep up with the politics, the incentives, the tariffs, and so on when we're missing over 400,000 workers that are needed to fill those positions. So it might be that the economy is doing the best that it possibly can do to grow. Lowering interest rates, raising interest rates won't really have much of an effect on that at all. It's just that we don't have enough workers, at least enough qualified workers, to fill all of these positions. It does suggest that continued investments in automation, investments in AI may gradually fill that gap. But at the moment, the economy is suffering, if it's suffering at all, not from the wrong economic policies or the wrong monetary policies. It's just suffering from a lack of workers. Let's take a look into the future now with the market outlook, and the headline is It's Time for a Plan. And I want to begin by talking about some core concepts of financial planning and just throw a little twist in there for you. These are the 5 elements of financial planning that I like to talk about. And the top one is really control, because the great thing about a financial plan is that it gives you control over all these things. Certainly, saving and spending, or budgeting as it's sometimes called, is one that you deal with on a daily basis. But in the middle of all of these concepts about financial planning, that would include who steps in if you suffer a disability, even what happens to your money when you die. All these things is this concept that we borrow from the science of decision theory, and that's called bounded rationality. And what bounded rationality means is this. Just like when your financial plan may have been delivered to you 10 or 20 years ago in the form of what we jokingly called the coffee table book, this 100-page plus bound book that was printed out on a color printer, and you could review anytime you wanted. It was usually too big to fit in a convenient place, so maybe you put it on your coffee table, maybe you didn't, but it was immediately out of date. And any financial plan that you devise is to some degree immediately out of date. Certainly the markets move, maybe that your relationships change, who might take care of your minor children changes, so on and so on. But we have this problem of bounded rationality because we do not every day look at our financial plan and tweak it to see what needs to be optimized. And the reality, again, is that there's often changes that need to be made. What I would suggest is that having a relationship with a financial advisor at BIP Wealth means that you have an agent in your life, in your financial life, that is there to constantly look at that plan and come back to you and say, there might be a reason for a tweak. There might be a reason for an adjustment here. So even if some of your risk management in the form of insurance is recent and well taken care of, even if your tax management strategies seem to be in place, even if your budget is sticking to the plan, we do have mechanisms where the investment strategy can respond to movements in the stock market on a daily basis. But with new tax laws in place, I think it could be reasonable to expect that there might be room for a conversation with your personal wealth advisor to see if now is the time to update some of these other parts beyond just the investment strategy. When we're doing financial planning, we have a set of tools that we employ to bring to you. And I want to go over kind of a simplified example of just a $1 million portfolio that's 60% invested in equities and what it means to have a Monte Carlo analysis. In this case, we're showing you what you might get in the future over the next 30 years. And so this Monte Carlo analysis has some interesting data. These lines show you all the different paths that your portfolio could take. And part of this comes from the fact that, again, it's 60% in equities, and it's not just that the stock market can go up and can go down. Even if we nailed our expectations that a 60% equity portfolio might go up 7.1% per year, sometimes the good years could happen right away and the bad years could happen later. We're using the computer to live out your financial life 1,000 times and graph these results. So in some of these 1,000, you have a great year right away, and in some, the great years at the end of your life. For somebody that just retired, having a bad year right away has a terribly negative impact on their final outcome. And so this dispersion of returns, where there's a 2.5% chance you're going to be at over $11 million, and there's a 2.5% chance you're out of money in 17 years, means that we're really just talking about the future in terms of a probability distribution. The median outcome is $880,000, meaning you've probably got enough money for spending $3,000 a month and raising that each year by 3%, but we just don't know for sure. Anyway, when we count up all the lines, 68% of them are successful in that you had enough money to make it for 30 years. Now let's contrast that with the next slide, where we change what we're going to do for the investor, but we also end up with the same chance of success. In this case, we're only investing 10% in equities, so a significantly less risky portfolio. Most of you would immediately intuit that, well, that means that the rate of return is going to be much less, but it also means that the range of possibilities is much less. And so rather than having the potential to end up with $11 million, there's a 2.5% chance that this investor could end up with $3 million. So the high end is much lower, but the low end is much higher. So instead of there being a 2.5% chance of running out of money in 17 years, there's a 2.5% chance of running out of money in 22 years. The median portfolio at the end of the 30 years isn't 800,000, it's just over 300,000. And of course, the return is significantly lower. But both of these have the same Monte Carlo analysis chance of success, 68%. And so it's kind of interesting when you're doing a financial plan for an investor and you see this, and in this case, we're just investing in equity benchmarks, and you can't actually invest in a benchmark per se. In one case, 60% equities, in the other case, 10% equities, but they both give you the same chance of success. And what I like to ask investors, certainly when we're meeting in person to talk about this, is what are the chances of success that you're looking for? If you've had your financial plan performed by your advisor at BIP Wealth, you have a number. And your number might very well be written such that you see it on client care or that you see it in your own quarterly portfolio report that says you have a 90% chance of success or you have a 70% chance of success. It's surprising how much I hear about from people wanting to have a 99% chance of success. And what that really means is that you're not spending nearly enough of your money to run out. And when you're making portfolio decisions, you're really investing for future generations or for the charities that you're leaving your money to. So here's one more take on this. And in this case, I'm showing the setup there. Again, you could have invested 60% in equities or 10% in equities with the same effect. But I'm not showing you the Monte Carlo simulation on the right. I'm showing you something that you probably never get to see when you're having your financial plan updated. What I'm showing you is something that your personal wealth advisor might be looking at behind the scenes. And this is what we call the efficient frontier. And I'd like to explain what this graph means because I think this is really core to our investing approach. And so if you look at the horizontal axis, that's a depiction of risk. The vertical axis is a depiction of return. And if you're like me, you'd like to have zero risk and that 18% return. If you could somehow get that, wouldn't that be nice? Treasuries are paying a little bit more than 4 right now, not 18. But if you look at this, and this is an expectation for what the market can deliver over and above the rate of inflation for the next 30 years, those circles are what you can achieve by investing in the equity benchmark and the fixed income benchmark. And so as you take on more risk, you have available to you a higher rate of return. The risk certainly seems to go up a lot. The rate of return seems to go up a little. But if you have a diversified portfolio, the willingness to take on more risk leads you to more return. Now, you may notice that above those circles, there is this line. And that line is graphing a much higher return for a given rate of risk. In other words, if I've got that 60-40 portfolio where you see that purple and blue shape there, you're looking at a standard deviation, that's a measure of risk of a little over 14, and you're looking at a rate of return that's just a little bit more than 7. But for that same rate of risk, there might be a portfolio available to you that has more than a 7% rate of return. Maybe it's 8, maybe it's 9, maybe it's 10, something north of that even. And the question that your personal wealth advisor is trying to answer is, for that given amount of risk, how do we get the return higher? Or even if that's the amount of return that's needed, how might we do that by moving to the left and taking significantly less risk? One thing I will tell you is that if your financial plan is trying to contemplate what would happen if you live a long life, there's nothing better than a higher rate of return for solving a lot of your financial problems and increasing your probability of success. And what I'll tell you now, and I'm generalizing for each of you, for everyone it's different, is that in almost every case, the way we get the return to be higher for the same amount of risk is by adding in private market exposure. And that actually does feed back to one of the key themes for 2025 about being diversified. We don't believe that you can be as diversified as you need to be in public markets alone. We think private markets, where there's thousands and thousands and thousands of companies out there that are not listed on the stock exchanges, will allow you to a higher return, and when combined with your public market portfolio, a lower rate of risk. And so if you see a level of risk there that feels familiar to you at all based on the percent that you are in equities, I'm sure you're going to look at that and say, I'd like that higher rate of return, please. And that is when the PWA, our personal wealth advisor, says to you, well, here's a new strategy we've never done before, but I think we want to consider adding that to the portfolio. Look, we just moved your probability of success in reaching all your financial goals from, let's say, 75% to 85% or something like that. That's what they're looking at behind the scenes. How do they get more return for the same amount of risk? A few things to acknowledge whenever we're working on somebody's financial plan is that we have to make some assumptions. So we make assumptions about the world. What's inflation going to be? What are tax rates going to be? What returns will the market provide? Order of market returns matters. We try to model for the uncertainty of that. We actually even model for uncertainty in the rate of inflation, where we predict that it can go up and down even around a certain average. But we assume certain tax rates. We assume certain market returns with the variability around them. And we even make some conservative assumptions around consumptions around, we make some conservative assumptions around Social Security that actually predict you won't get quite what's being promised at the moment. But what's a bigger struggle even is the assumptions that we have to make about you. If you're a young worker, what will your lifetime earnings be? So we might choose to be conservative in those assumptions so that we are testing your financial plan for areas of failure. We also have to make assumptions about how much you're going to spend, and the difference between the earnings and the spending, of course, is what you're able to save. Consumptions around your health are related to expenses, but also related to your life expectancy. And lastly, there is a big assumption that you will stick to your plan. Whenever there's a big market movement upwards or downwards, but especially downwards, we're prepared for the conversation where somebody is ready to bail out of their market. And often that can just be a disaster for your financial plan, because you've ridden the market down and now you're going to bail before you get to ride the market up, right? So being a long-term investor, sticking to the plan during the ups and the downs is a key thing. But all of these are assumptions, and in many cases, we have the ability to model some of these in a more conservative fashion than what we're expecting, again, attempting to find any weak points in your financial plan if any of these would be wrong. Now, I'm not going to spend as much time on this as I might like to, but we're leaving this with you. We'll make sure that a copy of this deck is sent out to each of you. But I wanted to talk about what seems like for many people a fairly benign investing strategy that is used, and that's called a 529 plan. A lot of young parents have heard maybe open a 529 plan, put a little money in each year for the kids because it does this amazing thing. It grows where the returns will always be tax-free if they're withdrawn for qualified education expenses. But the story is far, far better than you might have heard, and it just got even better. So I'm suggesting a optimized strategy here, completely hypothetical, of course, for a family that ends up having three children. And what happens in year one, in my suggestion, is that the grandparents, they might be our clients that have the biggest portfolio, perhaps more than they're going to need. And they fund the 529 plan for the first child using what's called the 5-year ratable exclusion, meaning that they can put in 5 years worth of gifting using up the next 4 years of gift tax exclusion without having to do anything special to their own estate plan. You can put all the money in at once. And why wouldn't you? In general, the benefits of a 529 plan occur because of the rate of return and the passage of time. And so front loading that investment almost always increases the value of having that plan and having all those tax-free returns. I'll tell you, it's great to look at a plan 10 or 15 years down the road and see that 2/3 of the value of the plan are market returns, not what you put into it. When child number two is born, the grandparents might want to do the same thing. And why am I saying grandparents? Again, they might be the ones that tend to have the money, but there's also something new out there, relatively new at least, where it used to be that if a grandparent was the one funding a 529 plan, then those 529 plan assets were counted differently when that child filled out the FAFSA, the free application for federal student aid. Money coming out of those 529 plans was counted as untaxed income and penalized the child's ability to receive scholarships and loans, but that law has been changed. So maybe in year 4, the grandparents fund again with the ratable exclusion. By year 6, they're able to do it again for child number 1. Now, what's interesting is in year number 7, the third child is born, and grandparents are funding. But in year 9, total funding is sufficient for all 3 kids. It's not that you couldn't continue to do some funding, but there's a little trick that a lot of people don't know about, and that is when you have children, again, all of the same generation, you can equalize or move assets around however you like from one 529 plan to another. But think about this from the perspective of child number 3. In year 9, they're just 2 years old, but they've had 529 plan assets compounding for them tax-free for 7 years before they were even born. So again, if you're going to have multiple kids in the family, loading up the funding for child number 1 as soon as they're born is kind of a key thing. And in this example, in year 9, they're going to equalize all of these so that all 3 children have the same amount in their 529 plans. And going forward, they might be able to use them for K through 12 private education. Now those expenses up to $20,000 a year can be paid for out of the 529 plan. If they're taking college classes in high school, they can be used to pay for that. And you know what? Even if they're not used for college or these K through 12 expenses, ultimately, they're eligible under certain conditions to have up to $35,000 rolled into a Roth IRA for the now young adult that had their 529 plan funded even before they were born. So continue the tax-free status. And so those funds can be used to pay for a CFP or their CPA if they're going to do that. Or even, let's really play the long game, they can begin to move those assets to their children down the line within the gift tax limits per year. So each of those 3 children can be moving $19,000 a year, at least at today's limits, into accounts for their children. So, boy, imagine that. Now you've got funds that have already compounded for 25 or 30 years tax-free, and now they're being moved into accounts for the newborns of the next generation. My point in all this is not to make y'all experts on 529 plans, but just to demonstrate with some of the prior updates to the tax law, plus these newest ones, there's all sorts of opportunities available to you out there, and certainly a good reason to update your financial plan. We'll go ahead and wrap things up here with a couple of key points. The first is that financial planning is, in our opinion, the foundation of your investing strategy. For instance, if you didn't do a financial plan that included all of these great elements of a 529 plan, how could you possibly decide what to invest in? I want to remind folks that many affluent families are planning for intergenerational wealth. In fact, as I said before, if you've got a financial plan that says there's a 99% chance of you being successful, what that means is there's a 99% chance that some or all of this money that we're managing right now isn't even going to be used by you. Even if it sounds like your chances of meeting your financial goals are pretty low, let's say you've got a 60% chance of success, we're really saying there's a 60% chance that your money is still going to outlive you and a 60% chance that you're planning for the next generation or perhaps for charity, depending on your preferences. Lastly, plans change. And I've certainly made the point here that the concept of bounded rationality may keep us from acting as quickly as we would if we were completely rational. Any economist trying to predict the behavior of us in an economy always assumes we're perfectly rational, always assumes we have perfect information, and always assumes that we'll make whatever changes necessary to comply with a new tax law or a new opportunity. We know that's not true, but with the help of your BIP Wealth Personal Wealth Advisor, hopefully we can continue to optimize your financial plan to stay up and current with all of the changes in the market and in the tax laws.
That's great. So thank you, Eric. Nice presentation. I'll start with a couple of questions, Eric. How often should someone update their financial plan?
Well, I'd like to suggest that there is a certain period of time that works for everybody. We certainly like to reference that financial plan every time we meet with you to talk about investment changes, even if it's only to acknowledge the level of risk that we've all agreed to. But the better way to answer that question, Bill, would be to say there's two times that should spur us to do that. One is when there's been a significant change in the tax laws, for instance. So we just had a big change in some income tax laws, in some cases preserving what was already there, but in other cases making changes such as to 529s, but a pretty big change to estate planning tax laws as well. So a big change like that could be a reason to look at your plan and make a change. The other would be when there's a big change in your personal circumstances. Sometimes people have a change to their health. Sometimes they get an inheritance. Sometimes, people get divorced, people get married, all sorts of things happen there. And so there's a big change in personal circumstances. So perhaps it is the broader world that changes, or perhaps it is your personal world that changes. Those are two great reasons to sit down with your advisor and get an update.
Good deal. All right. We have a question coming in from an anonymous. Tariffs haven't really had an impact on prices yet. Will you please explain it a bit more in detail why you don't think we'll have increasing inflation?
Sure, I'm happy to. Now, I will acknowledge the standard wisdom is that tariffs are inflationary. Tariffs are inflationary, and that cannot be avoided. The more complicated discussion happens around who is paying for the tariffs. Now, on its face, consumers pay for the tariffs, but it's not really quite that simple. So if we say, okay, there's broad-based tariffs across the economy on things that are being imported, let's first understand the basic mechanism there. So sometimes the new rules around a firm like Temu, for instance, and if you don't know what that is, they sell a lot of cheap Chinese goods here to the U.S., and they kind of exploded in the last couple of years. They've set up a lot of U.S. warehouses now. So let's say that if you were buying a pair of Nike shoes for $200, you might expect that the tariff would be applied to $200. Temu has figured out how to sell a knockoff to you for $100. You might think the tariff is going to be applied on $100, but it's really not. Temu may make those shoes for $2. They may export them to the U.S. into their subsidiary, their warehouse at a cost of $10, and then they still get sold to you for $100. But the tariff would be applied to the $10, not the $200 that Nike sells them for, not the $100 that Temu sells them for, but the $10 that they're priced at when they move across the U.S. So the first thing I'd say is I think the revenue coming from tariffs and the impact on inflation from tariffs have probably both been significantly overstated. The percent sound big, but that's not a percent of the final cost to consumers. Now, who pays that? Let's say that there was going to be a 20% tariff on that, so that $10 cost now has $2 tacked onto it. Well, there's a lot of options there. That shoe could be sold for $102 and then you paid it. You're the consumer. That $2 could be tacked on to the subsidiary bringing it in, or maybe it's even a third party company bringing it in. And they decide, look, I'm still going to sell it for $100. I've got a lot of markup here, so I'm just going to absorb it. Now, that's not inconsequential, but that would be a compromise in profit margins. And so the producer or final seller sort of eats that cost. Or the last answer could be that, the producer themselves over in China figures out a way to lower their costs or absorb that themselves so that somehow they continue to sell that shoe, maybe not for $2, but maybe for $3. So they were able to take half of that tariff themselves because they had some efficiency. China is struggling a little bit under these tariffs, and I'm imagining that labor costs, wages are actually falling there, so they might be able to take advantage of that to have lower costs on their end. So it is not a given as to who actually pays the tariffs. I mean, I know what the textbook example says, which is it's the consumer, but the real answer is very complicated, and we don't frankly know where the tariffs are being paid for at this moment. It just seems to not have resulted in nearly the impact on consumers that we might have initially modeled that it would.
Good. Thank you, Eric. Next question from Salah. So for 529 plans, should the contribution only be for direct children or grandchildren, or can someone contribute to the children of relatives?
So you can contribute to anyone's 529 plan within the limits of the gift tax law, which is $19,000 a year, without having to report that or without eating away at your now $15 million per person lifetime estate plan and gift exemption. I'll even say that you could contribute to a 529 plan for yourself. You can then, within the $19,000 limit, move it to your kids and they can move it to their grandkids. And so I don't think we've recommended that one very much, Bill, but I could open a 529 plan for me. You could open a 529 plan for you. Maybe you've decided that when you retire in your 80s or 90s or whenever you finally decide to stop working, Bill, that you want to use that to go back to college and get a degree in music or something. Who knows? But you can do it for just about anybody. And I think that perhaps more adults should consider opening one for themselves. But you've got broad flexibility there, again, given the idea that within family, you can move things up and down a generation each year within the gift tax limits.
Good. I like this next question from Peter. I have a significant amount of my portfolio in private investments and will be very committed to liquidity and value preservation later in my retirement. What are the risks of the private investment failures in the future? What situations could dramatically impact private investments and leave me short of money, say a decade or two from now?
Boy, that is a great question, and I'm so glad that Peter asked that one. Let me answer that in a couple of different ways. One is that the traditional way of investing in private markets is such that they're illiquid. And that was always the penalty. And that was one of the theories, is that that's why the returns were so much higher, is because you suffered the illiquidity of that, and that therefore came with a premium. So that is still the predominant way that we're investing in private markets, because the general partner that's taking that money has a long-term plan and they get their exit when they get their exit, right? That's still what we're usually facing, but there is a new breed of vehicles, less commonly on the equity side, more commonly on the fixed income side, whereby you can put your money in when you want to. In other words, there's not a series of capital calls out there, but down the road, you can request liquidity when you want it. And so as prices get presumably marked up, there can be a time when you're looking at the pie chart of your investment strategy and decide that the private equity or private fixed income wedge is too big and you want to reduce that. You can put in a liquidity request. Now, we always call it a liquidity request because there certainly could be economic dynamics, things like that going on that could limit that liquidity. There's always the fine print on that. But the intention is that there's significantly more flexibility. You've probably heard about BDCs or maybe even interval funds as the mechanism there. And we work with a variety of those to be able to give you that flexibility down the road to pull the money out. But what's happened in the last couple of years has also been fairly instructive. About 3 or 4 years ago, we all marveled at the fantastic return that we'd all been seeing in private markets, not just on the fixed income side, but on the equity side, where the rate of return was so far above the norm that we just couldn't believe it. But then we've gone through a period here of a few years where the returns have been lower, while the public markets have been a great source of return. And that's sort of the argument for being diversified across both public and private markets. They don't tend to move together, and that's honestly one of the advantages of doing both and combining them into a portfolio. Your total portfolio is much more stable across of that. So I think that it is always important to understand that there are limits to how much you should invest in private markets in the type that will be illiquid until the general partner is able to generate an exit. But we more and more have opportunities to participate in private markets where that liquidity option, we expect to be there in almost any kind of environment, probably leading people to do more and more in private markets and less in public as they try to take advantage of those higher returns.
Good deal. Thank you, Eric. Last question I'll ask you is regarding financial planning. You had a pretty comprehensive slide about 529 plans, but also financial planning includes insurance, not just life insurance, but property and casualty. It includes estate planning. It includes tax planning. Do you try to tackle that all in a 30-day period, or what's the best way to approach a comprehensive financial plan?
Well, sometimes it can be a little bit daunting, Bill, as you well know, when you're working with an investor and you build this mountain in front of them and say, here's all the stuff we've got to do. So I like to come up with a to-do list and then start with some of the most foundational things, making sure they've got an estate plan, that we know what happens if they suddenly are faced with a disability, and then begin to knock these other things out. I love it when I see a client's quarterly portfolio report that lists these to do. Here's the things we're going to do next. Here's our goals for things we're going to try to knock out. And so it's every investor has a little bit of a different set of priorities, but it is the rare individual that says, I'm going to stop everything else I'm doing, meet with my attorney, meet with my tax preparer, meet with you, and do nothing but this for the next 30 days to get it all updated. And often it's the case that if we're staying current, maybe only one or two of the major parts of this need to be adjusted. If you just got your estate plan done in the last year or two, it contemplates in all likelihood some of these changing exclusion limits and stuff that we just got. But hey, there's some new tax laws, so maybe we really just want to meet with you and your tax advisor and talk about some tax strategies, or maybe that's actually nailed down pretty well, and we just want to talk about some of the new investing opportunities that are going to change the amount of risk that you need to take. But yeah, it's a little bit different for everybody, but usually it takes more than one or 2 months to get it all updated.
Thank you, Eric. And great job today. Fantastic job. Thank you, everyone, for joining us today. Hope you have a fantastic weekend, and please reach out to us if there's anything that we can do for you. Thank you.
Thanks.